What's up, boys? I'm gonna be talking about some of my entries and what I use as confluences for my entries, how I figure out where I want to set my take profit and my stop loss, and yeah. Before we get into any of that, I want to tell you guys one thing that is pretty much my main confluence. Um, every single implied move in the market, which an implied move is just a change in the market's uh, direction. So from bullish to bearish, bearish to bullish, etc. Every single one of these moves is started with a break of structure, as you can see right here, a break of structure, and then a first fair value gap. A break of structure is just a candlestick body that closes above or below the last candle in the opposite direction. So this would be a break of structure right here. Actually, let me add brush to this shit. Make it a little easier for you guys to see. So this right here is a break of structure. This candlestick right here is a break of structure because it closed above the last bearish candle. The candlestick body closed above. And so what comes next? A first fair value gap, which is this. And that is the close of the candle's wicks in a three candlestick pattern. The first and the third candlestick wicks do not touch. So this is a fair value gap. And as you can see, this is literally my point proven right here. And I only took 3 trades today. I actually probably would have made a lot more money if I didn't have stuff to do this morning. But I didn't even look at the markets until about, I think right around here. Probably about 1 o'clock I started looking at the markets. Um, but yeah, and as you can see, we have a break of structure. First fair value gap. Price comes down, retests the first fair value gap. First fair value gap is respected. And then boom, right up here to this external liquidity up here. What happens again? We have a break of structure, efficient break of structure, first fair value gap in that efficient break of structure right here. And what happens? Price comes back up, retests this first fair value gap. Boom. Comes down here. Sweeps a little bit of liquidity down here. Comes back up a little bit. Retests this fair value gap just a little bit. Barely taps into this first fair value gap. Comes right back down. Sweeps a little more liquidity down here. Comes back up. And then comes down and sweeps all of this liquidity. Okay? So I'm going to show you guys how that plays into my confluence for it. And I will show you guys right here, just so that way you guys know I'm not capping. Let me find it. A screenshot of my thing. But, I mean, this works too. So I took 3 trades today. All 3 of them were winners. First one I took, I actually should have let run, but I probably missed out on like $100 of profit, but I'm not mad at it. And you guys will see why I got out of that trade as well. But yeah, 3 for 3 on the day. $700 in P&L. Not a bad day at all. So this trade right here, these are my actual exact entries and exits. I went back and looked at my trade history so that way I could show you guys exactly when I entered, when I exited, and I can show you guys exactly why I did that. All right, so first trade, I did kind of rush this a little bit, I feel like, but then again, I didn't. I don't know. I just took this because I saw how price was reacting. I saw it bounce right off of this first fair value gap up here. And I saw price almost tap into it again. And I was like, you know what? Fuck it. I'm going to try and top ticket. And I did. Then I had to go. I think I was making lunch or something right here. I was doing something right here, right around here. So I moved my stop loss up here, right behind, right where this first fair value gap was started. And that was my exit price. Because, yeah, price ended up coming up. But I honestly, if I was paying attention to the charts and looking at my computer screen at the time, I would have exited right here. This is the candlestick I would have exited on. Why? Because if I see a confluence that I would possibly take in a trade to the inverse of whatever my trade is going, whichever way my trade is going. So if I'm in buy orders or sell orders and I see the opposite confluence, then I'm getting out of the trade just because that's just not what I want to do. It means price is going in the opposite direction according to me and my rules, and I wouldn't take that. So as you guys can see, it came down here, swept this little bit of liquidity. What do we have? Efficient break of structure to the upside. What do we have next? A first fair value gap right here. What happens to this first fair value gap? Price comes down, retests first fair value gap, boom, right back up here. So it wasn't a losing trade, but I definitely could have held this all the way down here. But it is what it is. I'm not really mad at it. I got another entry anyways, so I'll show you guys why I entered right here as well. So yeah, that's the first trade. It wasn't an L. I think I made like $25 in profit or something on this, so I can't be mad at it. Rather get stopped out in profit than not in profit. Like I said, I probably would have made a lot more money too. I probably would have made a couple hundred if I would have seen this, but I just let the trade run after this. I was like, fuck it, I'm just let it run. The second trade for the day, as you can see, what do we have? We tried to tap in to this liquidity. It didn't tap it yet, but what do we have? An efficient break of structure. And then a first fair value gap right here. And I think we had one on the 2 minute and the 3 minute, I believe. Something like that. First fair value gap. I thought it was going, it like almost tapped into this first fair value gap, which it kind of did because this was the beginning of the first fair value gap. This stick came up, retested on the first fair value gap. Price was respected. I entered right here off of the retest. Boom. Took it all the way down until all the way down to the external liquidity. And I didn't know if price had enough action because price action was kind of weird today. It was a little choppy, as you guys can see, which I love, but I didn't want to take profit all the way down here. Probably could have added a couple extra hundred onto my profit, but I set my take profit right here because this was the next source of external liquidity right here. And I also set my stop loss right above this first fair value gap. Because if I see this first fair value gap get disrespected and traded through, then there's not really any point to keep the trade. So that's why I set my stop loss right here. Yeah. And then as you guys can see on the third trade right here, what do we have again? We tapped into a huge source of external liquidity down here and tapped into a first fair value gap that has been here since this morning, early this morning. Tapped into it. What happens? Efficient break of structure right here and a first fair value gap in that efficient break of structure. So that was a money play for me. Then I waited for price to come down and retest. It didn't. I took the trade right here. Boom. And took it all the way up to the next source of external liquidity. And I probably would have let this one run a little longer since I already hit this trade and, hit a winner with this trade. But it was 3 o'clock, I believe, 2 o'clock. Yeah, it was 2:30 and I had to be somewhere at 3. So I didn't want to hold this trade while I was driving and try driving and looking at the trade and everything. But yeah, so I hit a 4 RR, a 3.7 RR, and then I hit this one for, pretty much, we'll just say this one was break even because $25-$30 isn't really anything. But yeah, I just want to go over my entries and my exits. And yeah, pretty much what I wait for is a sweep on liquidity. Sweep on liquidity. An efficient break of structure. So this is a great example. An efficient break of structure off of a sweep of liquidity, external liquidity. A first fair value gap. Make sure that first fair value gap gets respected. Enter. And then my take profit is going to be at the next source of external liquidity. And my take profit is going to be at the bottom of the confluence for me getting into this trade. So the first fair value gap is going to be probably right below it. I like to give like a little bit of space, just a little bit of space underneath the first fair value gap, just because sometimes price will come down, trade through it just a little bit, and then wick up and have a reaction. So just keep that a little bit in mind as well. But yeah, what you want to see is a tap into external liquidity, like right here. I would have taken this trade right here if I didn't have stuff to do this morning. But, it is what it is. Would have been crazy RR. But yeah, like right here. What do we see? External liquidity gets tapped into. This external liquidity outside of price range. There's a whole lot of orders sitting up at this price range. Taps into this liquidity. Comes down. What do we get? An efficient break of structure. Right here. What happens inside of that efficient break of structure? First fair value gap. What does price do to that first fair value gap? Comes up. Retest the first fair value gap. It gets respected. Boom. What else do we get in this respected fair value gap? What do we get off of respecting this fair value gap? We get another first fair value gap with a break of structure. An efficient break of structure. It's super simple, guys, but in order for this strategy to happen, you do have to have a lot of patience. You really have to have a lot of patience for anything, but yeah, you definitely have to have a lot of patience for this. And look, we'll even go over some more examples. Like I said, every single implied move in the market has to have an efficient break of structure and a first fair value gap right here. It's very small, but there is still an efficient break of structure and a first fair value gap off of a liquidity sweep. It didn't even really sweep this liquidity, but did it? Well, I was still trying to sweep this liquidity, but it swept this liquidity. What happens? Efficient break of structure, first fair value gap, boom, all the way down to the next source of external liquidity, right here. What happens off of that external liquidity? What happens? And this one is actually marked out by my indicator. Shout out to Andrew Macri. Absolute killer of a indicator. If you guys have $30 to spend, I would definitely cop his indicator. Absolute. It's not a must-have. I mean, there's indicators that you can kind of use for free to map it out a little bit, and I might have a video going over some free ones that I used to use. But his indicator is super, super helpful. What happens though off this external liquidity? Boom. Efficient break of structure. First fair value gap right here. What happens then? Price tries to come down and retest it a little bit on this wick. Shoots right back up. First FVG gets respected. Boom. What happens? All the way back up to the next source of external liquidity. And then we have a huge, huge first fair value gap right here. So that means it's going to be respected on probably the 15-minute. Where did my shit go? Oh my god. See, that's why I've not been changing price. I'm trying to show you guys shit. This is Friday. This is Sunday. This is Tuesday. Where were we at? We were right at about market close, I think. God damn it. Where were you at? Is it right here? Yeah, right here. I don't know why my trading view bugs out while I'm trying to back on shit. But what do we have? A huge first fair value gap. This is definitely respected on probably the 5 and 15 minute. Definitely probably a fair value gap on both of those time frames as well. What happens? Boom. Sweeps out all this liquidity. It just runs through this liquidity. And it's actually sweeping some of this liquidity all the way over here. All the way from last Tuesday. So, as you guys can see, comes up, sweeps this liquidity. What happens in this next implied move? Even though this is mostly consolidation, what happens? What do we have? I'm telling you, every single time, efficient break of structure and first fair value gap. Every single implied move has a efficient break of structure and a first fair value gap. And you guys can use the different time frames. I would use the different time frames right now to show you guys examples, but it literally is just fucking up my, like, I don't even see my trades on here anymore. I don't know why my trades aren't even here. I had them all mapped out, but it's whatever. That pretty much goes over my entries, and I usually look for efficient breaks of structure on the 2, 3 minute, and 5 minute, and 1 minute. I usually use these 4, and sometimes I'll use the 15 as well to look at entries. But if I'm entering a trade, it's usually on the 1, 2, or 3 minute. Just because sometimes if you use the 5 minute, like I'm pretty sure I used the 5 minute on this trade, you just enter a little bit too late, and yeah. But I mean, if you see a efficient break of structure and a first fair value gap off of a liquidity sweep on the 5 minute, 3 minute, in like 2 minute, 1 minute, if you see all those confluences on all all 4 time frames, then it's a very high probability that that trade's going to win. But usually I look for it on the 2, 3, and 1 minute. It's usually what I enter on. And if I usually look for it to happen on the 2 minute and the 1 minute, or like the 1 minute and the 3 minute, so forth. I usually try to find an efficient break of structure and a first fair value gap on at least 2 of these 3 time frames. Now I also look at the 5 minute just to check and see, because it would just make my bias even stronger for that trade. But yeah, I'm pretty sure that I covered just about everything. I'll take these off just for whenever I go back testing. Yeah, I'm pretty sure that pretty much goes over most of my confluences for entries and exits. Like I said, wait for the liquidity sweep. Wait for a first fair value gap to get formed off of that liquidity sweep. Wait for price to come back and retest it. If price is respected again with another efficient break of structure, boom, enter. Put your take profit, like right here, boom. What do we get off this candle? We get an efficient break of structure, and we get a first fair value gap right here. You would enter on this candle, take it to the next source of liquidity, which would have been right here. Boom. Easy. Set your take profit down at the next source of external liquidity. Set your stop loss right above. Just a little bit above. Who the hell is texting me? Right above the first fair value gap, which is our confluence. Right above the first fair value gap in the break of structure, which is our confluence for getting into this whole trade. And then, boom. It's easy as that. Then while you're watching the chart, just make sure that you're looking for pointers, which I call efficient breaks of structure pointers. Just wait. Look for any pointers in the inverse or IFVGs or first fair value gaps. FFVGs, IFFVGs, whatever, in the opposite direction that you're trying to make the trade in. So if you see market moving, that's just a sign that market is moving in the inverse of whatever you are trying to trade, whether it's buy or sells. Because that's our confluence for entering a trade. Why would we hold a trade that is showing that a entry into the inverse of what we're trying to trade? If you get what I'm saying. Know if I'm wording that correctly, but yeah. I think that's pretty much it. If you guys have any questions, feel free to ask. If you guys are looking for a completely free trading Discord full of just people trying to just become profitable, I drop a lot of free sauce in there. Anybody is welcome. The link is in the description. It's in my bio, or you can DM me on Instagram, BRAYDEN.NQ, if none of those links work. Hopefully this helps you guys out a little bit. Sorry for the delay on the videos. I've just been super busy lately. Yeah. I think that covers just about everything. Good luck on the charts, guys. And I'll see you guys here probably tomorrow. I'm going to try and drop another video. So be on the lookout for that tomorrow night. Peace.